passive versus active investing. And I think the key issue has been, is it cheaper? Is it the fees, the fee structure? We do have you guys talking to Rosalind Zhang of China Investment saying that one common pressure on the fee side, the average profitability of the industry should come down as management fees are pressured lower. The industry needs to be more cost efficient, otherwise the business risk is high. A key existential question for these investors.
Yes, it's really interesting because Rosalind Zhang is the head of hedge fund investments at the Sovereign Wealth Fund, CIC. And she basically said if hedge funds don't get on board in terms of aligning their interests with the investors, that their investors are just going to walk away. And we've already seen investors do two things. One, pull money out of hedge funds, or two, really put weight behind pressure saying, hey, we are going to pull money unless you change your fee structures from the traditional 2 and 20 to align it more with performance.
Who's left doing that, though? Is there anyone out there who charges 2 and 20 anymore? And if they do, they probably deserve it.
You're right, Vani. So I wouldn't say that the 2 and 20 model is the traditional or the norm anymore. We've definitely seen a lot of hedge funds drop the management fee to 1 or 1.5, but there are some hedge funds that still are out there that are charging performance fees of 20 or even 30%, but they have to be delivering in big numbers.
Yeah. So do these hedge funds even have a future now?
You know what? A lot of people say they do, but they're really going to have to reposition themselves away from some of the strategies that really built up the hedge fund industry. We had stories this week by the colleagues on my team about how long short is really struggling. That's the strategy that put the hedge in hedge funds, but we've seen a lot of them really struggle because of low interest rates, low volatility, and as you mentioned, the rise of passive.
Yeah, there was a great quote in your story today, you know, that there's nothing to hedge really, and when you do pick something, well, you're just going to get pain, you know, it's just going to be pain for you because nothing needs hedging these days. Everything is going up.
Exactly.
Or going in that direction. But I want to mention what Mark Asri said in your piece. He said, right now what the investing world offers you is niches, and to find these opportunities you need a big team. This trend of bigger firms will become more pronounced, so will requiring longer lockups for investors. I get the lockups thing. You know, you want to try something a little edgy. You don't want your investors getting cold feet pretty quickly. But the bigger teams, the bigger, you know, why do you need bigger to find niches?
Well, one of the issues with niches is that they're literally hard to find. They're not mainstream. So what he's saying is you need to build out a team of people that can go out and find these niches, whether it's litigation finance or real estate, and that's going to require more people to do due diligence. We're really seeing a lot of hedge funds start to build out or transition some towards the private equity play, but that does take a lot more due diligence on deals. You have to really go through the companies and figure out, hey, is this non-publicly traded company worth going into? We also interviewed Howard Marks for the piece, a giant in the alternatives investing industry, and he made an interesting point saying you're going to see a lot more demand for these alternative investments, these private niche things, but they're not infinitely scalable, which I thought was a really interesting point. So he's saying it's not like the public markets where you have tons of money sloshing around and tons of opportunities. So people are really going to have to struggle to do well and to find the teams with the people that are going to do well because there's just not as much there.